Hey, welcome everybody. It's John with Rain King LLC. It's time for a general market update. Today is December 1st, 2023, recording this approximately 12:30 p.m. Eastern Standard Time. Again, a reminder, Rain King LLC is for educational purposes, and I'm an amateur individual growth stock investor. So here's our agenda. We're going to spend some time on the indices, quickly touch base on the trend monitor, and then we're going to spend probably a bulk of our time on portfolio and position management, kind of an educational section that I hope you'll get something out of, and then we'll wrap up. So the indices. Here is the S&P 500. I cut this chart at around 11:15 a.m. So you can see we've had this strong push higher, and basically we're going sideways the last 4 or 5 days, which is pretty normal given it's right back at the pause at the July highs. That's all normal, but what's really helpful is we see that the new highs the past 2 weeks have really been picking up some steam, which is great, and we're seeing the new lows dry up. So that's a very, very constructive picture. We haven't had that for months, since going back to the summer. So that's encouraging. Now, this is a chart, a comparison chart. So let me take you through this. I've taken the QQQ as this black line as kind of the baseline index. And I've used this chart from the dates of 9/29 of this year till yesterday. So we're looking at the performance of the Qs, which you can see over the Qs the last 2 weeks has basically been sideways. And one of the components in the Qs is NVIDIA, and you can see I've got NVIDIA in this dark gray, which has also been down the last couple of weeks. So you can also see in the colored lines, these are leading stocks above here. These are outperforming the Qs at the moment. Names like Shopify, CrowdStrike, Melly, Nutanix, Now, and the ARC Innovation Fund has just completed a great month. It was up 32% in November. So if you put the follow-through day on here and say, what's the action like since the follow-through day? You can actually see that the Magnificent Seven, though it's come up, it's actually been kind of going sideways for the past few weeks. And the point I'm making is there was so much money stuffed into the Qs throughout the balance of the year, as you know, the trade. It's very possible that money could come out of the Qs, and the Qs might underperform when money starts to get reallocated into more of individual growth stock names now that the environment seems to be improving. So it's something to keep in mind. Again, here's the daily chart of just the Qs and some candles. And you can see the point I'm trying to make here is today, the day is the Qs are actually down 0.4%. But many growth stocks are actually outperforming. That's telling us something, that money is rotating, possibly from the Qs and moving to other areas of growth. Might be moving to the ARC fund. You can also see that the IWM, the small caps, are having a good day. They're up 2%. So that and the ARC fund is also very strong and powerful today when the Qs are down, are suggesting that maybe we're getting rotation out of the Qs. And a lot of people are still focused on the Qs because they really have recency bias, because that was the trade pretty much all year. So some specific names today, which are really responding well to earnings. This is Elastic, had a big gap up, big earnings surprise today, acting well. Crowd a few days ago had an earnings gap up, a good reaction. Palo Alto was also a really interesting read on the market. You can see it had a poor earnings gap down, but immediately the stock reversed strong and broke out, and it's really starting to run. So even though there were some short-term sellers, the stock has been bought up. So it's another very constructive, positive thing that we did not see during the bear market. And here's a firm on the right. This stock has had a breakout. It's had good volume for multiple days, very strong action. So we're looking for change. And over the last month, we have seen that growth names are really responding well to earnings reports and the guidance and view that portfolio managers are seeing forward, that these names might be worth investing in because they have growth trajectories and interest rates may be gradually coming down sometime in 2024. So those are really important action we're seeing. Let's go to the trend monitor. This is actually the National Active Manager Exposure Index. These are active portfolio managers and their exposure levels. I've shown it before. The S&P here is on the bottom. This is the actual number of portfolio managers or exposure. They're currently just below 80%, but you can notice that, just a couple of weeks ago, at the end of October, they were only at like just above 20%, which you usually only see way back at market lows like we saw in October of 22. And so the yellow zone typically means when you're in corrections. And then when you get above 80, things get a little hot. And you can see in July, we actually were up in the on 100% range, and then we had our correction. So we're in the 80% range, but there's definitely been catch up with portfolio managers scrambling to get long positions. So the trend monitor right now, we talked about it last week. The power trend is on. We did have a distribution day, but it was fairly mild, and we've paused at the old July highs. So everything is really constructive. We still have the power trend. Bases and breakouts, we are seeing lots of names working. We're seeing new issues working. We're seeing earnings gap up in growth. This is all really encouraging to see. We haven't seen this in a long time. Net new highs, we have net new highs on the NASDAQ and net new highs on the NYSE. So we finally have gotten this piece in place, which is excellent. I mentioned we're above the 20-day, the power trend's in place, and we have been seeing good breadth in the market over the past month. So the breadth is widening out, and we're seeing a lot more participation, which is good. Particularly if we get a soft landing when we're starting to see the Dow and some of the industrials and materials stocks starting to outperform as well. Volume, the price and volume action right now that we're seeing in growth has been very constructive. We're seeing increases in volume on up days. We're seeing lighter volume on the pullback days. So again, very constructive. All the components are in place. So let's move into portfolio and position management, kind of an educational section. And I pulled this together because I think it's really relevant to where we are in the market right now. So, winners in the market tend to have very consistent profitabilities, and most importantly, they control their drawdowns. They have to really manage their risk well in order to perform. So if this were to be your equity curve, as the equity curve is moving up, they really work hard, successful people, to make sure their drawdowns are really 10%, 15%. Try to keep those drawdowns to the 10 to 17% level, and you'll have a pretty steady rising equity curve if you do a good job managing risk of the portfolio. Now, people that are not consistent in the market and lose money in the market tend to be seeing wild swings in their equity curve. They get on a heater, they really have some good trades, their equity curve spikes, but then they also have some very severe drawdowns, 25%. And they have another spike in their curve, and they come down 60%, or big drawdowns over 50%. These are the type of people that have winning streaks, and then they get knocked out. They lose all the account. So we strive to be number one. So let's talk a little bit about things you need to consider in order to be more of a consistent winner in managing your risk and having a steady equity curve. So all of this is by actively managing your positions and your overall account. So I look at it as a birthday cake, and the birthday cake has 3 layers. We have the lowest layer, the biggest layer is your entire portfolio risk. Then we have the middle layer, which is sector risk and industry risk. And then we have all these individual trades that we're taking, individual trade risk. And we need to look at the entire cake in its layers in order to understand how much exposure we have to the market and risk. So one easy thing you can do is just take a look at all of your positions and your stop loss positions where you've got them set. And if all your positions got stopped out, ask yourself, how much of a drawdown is that? Now we know that we dabble in growth stocks, and growth stocks are going to correct 2 to 2.5 times the market indices. It's really important to understand that concept. So, if the market pulls back 5%, your stocks growth stocks are probably going to pull back 10 to 15%. So we want to keep our portfolio drawdowns to the 10 to 15% max as a portfolio. And we want to do that because we want to stay within equity new highs. And if you get hit with a drawdown of 25, 30% in your account, it can really mess up your mental state, your psychological capital, and it's very difficult to recover from. So portfolio risk is something important. A couple other rules of thumb for those of you that may be partaking in margin. Margin is only for certain environments, but you got to be very careful because you can lose money just as fast as make money. So when your equity curve is up and you come off 8% off those highs, you really should be getting off margin as a rule of thumb. You get to 10% off your highs, you should start raising some cash, and 15%, you should definitely get out of the market unless you've got a position with a large amount of cushion. So be careful on margin. You've got to act even quicker to control your portfolio risk because just as fast as you can make money, you can lose it just as fast. So let's move to the next layer of the cake, which is sector and industry risk. We want to be very aware that how much risk do our stock picks in one sector or one industry. And a rule of thumb is to not have more exposure in one industry or sector of 25 to 30%. So it's important because if a sector starts to rotate with money leaving that sector, you could be very exposed to a drawdown. And I've shown if you have 6 trades, and I've shown here 5 of them with semiconductor industry exposure, your portfolio is fairly exposed there. And if we get a pullback in the market of 10%, and the sector starts to sell off, your stocks could come down 30%. So it could be quite swift if you're not aware that you are over concentrated in a sector. So as an example, if you had a $100,000 portfolio and you were invested across, say, 10 names, and let's just say, for instance, you had $50,000 or 5 names in the portfolio, all in semiconductor names, and the market starts to correct, and your semiconductor stocks correct 15%. With that kind of exposure, you're talking about a drawdown of the 50,000. You're going to lose $7,500. And you'll take a look at that and say, wow, that's 7.5% of the entire portfolio got wiped out in one day. So sometimes you're not aware of how over concentrated you are. So just be aware of that and try to make sure you're balanced or you're okay with taking that much exposure and risk in a sector. So the third layer of the cake is our individual trades. And we want to be looking at the charts. We want to be looking at what we want to anticipate. We want to set expectations for their charts, what we think is going to happen, but we also have to be very, very flexible to accept things that don't go our way and to take action. So, when you have individual stocks, you really, really want to have a written plan. Where you bought, what is your stop loss, and you want to have that plan developed when the markets close, when your thinking is clear. And we always want to prepare for the worst. You want to have both plans. You want to have an offensive plan to say, what will I do if things go in my own direction? And a defensive plan. What am I going to do if things go against me and my stops get hit? Do I have too much open risk? If all my stops get hit, I'm not comfortable with that drawdown, then you might want to adjust your stops or your position sizes, etc. So you need to have a plan for each of your individual names, but you should look at them collectively as well in order to manage your risk. And do a mental rehearsal. Look at the charts, anticipate what might happen next as you're developing a positive and negative plan, and really, really watch FOMO. You don't want to be chasing stocks, and get caught up in buying too high and raising that average cost. We talked about that in great detail last week, and a number of you gave me some very positive feedback about that segment. So we want to look at this all together on all the different levels in order to manage risk. So again, a couple of other rules of thumb. Position size is really calculated on your risk tolerance and your money management rules. So a general rule of thumb is you don't want to risk more than 1% of your account on any one trade. So why is that a good rule of thumb? Well, it allows us to make many mistakes and take many small losses and still stay in the game. Our account stays intact. If you take 5% account risk on one trade and you get 3 trades in a row that get stopped out, your account is going to be down 15% in the blink of an eye. And that's too much. We talked about that's really the limit of the drawdown. So 1% is a good guide. Personally, I try to keep it to 0.5% to build in more failure into my system. I'm only limiting my risk to 0.5% of the entire account on a trade. It allows me to take multiple trades and really not get into trouble. So here's an example. If you have a $40,000 account and you want to risk a maximum of 1% on the trade, that's a $400 you're willing to risk. If you have a $10,000 position, assuming you're going to have 4 positions at 25% size, and you're going to risk the maximum of $400. So we take the $10,000. In this case, if it's a $50 stock, you can buy 200 shares of the stock. Where would your stop be? Well, our stop has to limit the risk at $400. So really your 200 shares times 2% is $400. So you can only risk 2 points on the trade, or 4%. So you also, in setting this mathematical stop, you really want to ask yourself, does that stop make sense on the chart in terms of support and resistance areas? Just because it makes sense in the math, it might not make sense on the chart. And you mean if your chart is telling you the proper stop loss is bigger than 4%, then you either have to downsize the trade size or maybe avoid the trade. So I know a lot of slim investors use the 7% stop loss rule. So if you were buying a breakout in this example and you say, I'm going to use 7% as my just standard stop, that's a case where you're going to have to reduce the position size down to 5,700, because if you're only going to be willing to lose $400, which is 1% of the account, you've got to shrink the position size because we have a wider stop. So this interrelationship is important as you're trying to manage individual risk on your positions and as they roll up to your account. So here's a quick hack. When we have a rally, we talked about average cost and understanding we don't want to raise it too quickly, and also bracing for potentially a pullback. So, if you have an example where the market is getting extended and it starts to pull back, I'll emphasize again, growth stocks are going to pull back 2 to 3 times the indices. So you need to be prepared. So in this example, let's assume stock A3, you have some gains in some stocks and you have a couple losses in some stocks that you're currently holding. And you see the market start to pull in and you want to say, how can I prepare for that? So here's a hack that I use. So the hack I use is I try to balance small gains with small losses during the pullback. And the idea here is to close up the positions with small losses and small gains because they're going to pretty much likely to offset each other. And I'm doing that because I'm trying to protect the big winner that I'm trying to hold. So as I mentioned, if you only cut the losers, in this case, these 2 in red, if you cut those, okay, and you take your losses, and these little small gains on the pullback get reduced to 0, well, you've eroded the big profit in your winner because you don't have any gains and you have losses that are eroding the gains in the winner. So balancing these small meaningless gains and losers with these small little ones is important. That's the way I do it. You can basically, you're going to generally wash each other out to be a 0 or close to 0. And that allows me to take the stock that had the 50% gain and try to really hold it through a pullback. I might have to give back 10 to 15%, but I don't want to dislodge the position if I have good cost. So that's our little educational segment. Let's try to wrap up for the week. So again, the follow-through day is working, the power trend's on, the trend, everything's in place now, so things are working. We're in a seasonally good period for the market, so we want to take advantage of it. Keep building the watch list. Leaders are certainly up and out, and there are more names setting up every day. So it's a pretty target-rich environment. Exposure levels should be up a little bit more. I got them to 60 to 85. Some of you might already be at 100, which is fine if you're comfortable with that risk. We continue to get good positive feedback. I always like to keep a little bit in reserve so I can add to my big winners, to add to those on the pullback. So for me, I want to keep a little bit of my powder dry. When we do get this pullback, or maybe it's only a pause, it'd be really normal, and we want to watch it very carefully to take a look at the health of the market. We want to look at the leaders, how much they actually give back. Are they holding gains? We did have a distribution day this week, but it was mild, and it was spaced out quite a bit from the last distribution day, so we don't have any clusters. So what I would recommend you do this week is take a look at your positions and your portfolio. Take a look at your open risk and how you're going to keep it in check during the pullback. So review the portion of the video that we just talked about with how do you do that on using the layers of the cake. And I think you'll find it beneficial to improving your equity curve. So the quote of the week is from Charlie Munger, who passed away this week, from Berkshire Hathaway. It isn't the learning that's so hard, it's the unlearning. A lot of things in investing are counterintuitive to common sense as human beings. Words like cheap and expensive, overvalued, undervalued, oversold, undersold. There's a lot of things we all as individuals have to unlearn in order to really listen and learn to how the market works so we can actually take advantage of it and make some good money. So here's to Charlie Munger. He's the quote of the week. And that's the general market update for December 1st, 2023. Here's where you can find me on X, YouTube, and Rain King Bull Bear at Gmail if you want to send me a note. Look forward to seeing everybody else next week, and have a great weekend.